Costing and pricing. Before any business can really get going, it's important to figure out the cost and price of your product or service. This helps you understand your expenses and profit, making sure you can run things smoothly and keep the business successful in the long run. What is costing and pricing? Costing and pricing is all about figuring out the total expenses for making a product or offering a service. Things like materials, labor, and overhead, and then adding a percentage on top for profit. That's how you come up with the final price. It's a super simple and effective way to make sure your costs are covered while still earning a nice profit. Let's go in depth with costing. Costing is all about figuring out all the expenses that go into making a product or providing a service. This includes stuff like materials, labor, and overhead costs, such as rent, utilities, and equipment. The main goal is to understand how much it really costs to produce something, so you can set a price that covers those expenses and gives you a profit. How can costing help your business? Pricing decisions. Knowing your costs lets you set prices that cover your expenses and still help you make a profit. It's all about finding that sweet spot where you're not just breaking even, but actually earning some money. Identifying inefficiencies. Analyzing your costs can show you where you might be overspending, which gives you a chance to tweak things and boost efficiency. It's a great way to streamline operations and save some cash. Profitability analysis. When you understand your costs, you can see which products or services are bringing in the most profit and focus on those. It's all about putting your energy where it counts the most. Investment decisions. Accurate costing helps you make smart decisions about investing in new projects or expanding your business by showing you the potential returns. It's all about knowing where to put your money for the best results. Budgeting. Costing helps you create a budget by giving you a clear picture of where your money is going, which is super helpful for financial planning. It makes it easier to track your spending and make sure you're staying on top of your finances. Financial reporting. Costing gives you the essential data you need for financial statements, which helps you track how your business is doing and keeps everyone, like investors and directors and shareholders, in the loop. It's key for good communication and making informed decisions. Overall, costing is a vital tool for making smart business decisions and paving the way for long-term success. It keeps you informed and ready to tackle whatever comes your way. Types of costs. There are several types of costs that businesses typically deal with. Fixed costs. These are expenses that stay the same no matter how much you produce or sell, like rent, salaries, and insurance. They're your fixed costs, and they're pretty predictable. Variable costs. These costs change based on how much you produce, like raw materials, labor, and shipping. So the more you make, the higher these costs will go. Semi-variable costs. These costs have a mix of fixed and variable parts. For instance, think of a phone plan that has a base fee that's fixed, plus extra charges if you go over your minutes, that's variable. Direct costs. These are costs that are directly linked to making a specific product or providing a service, like materials and direct labor. If it's essential for production, it's considered a direct cost. Indirect costs. These costs are not tied to a specific product or service, but they're still essential for keeping everything running smoothly. Think of things like utilities, administrative salaries, and office supplies. They're all part of your indirect costs. Cost calculation formula. This easy and commonly used formula for calculating costs is perfect for smaller businesses or those just getting started. It's simple to use and gives you a good idea of the basic costs of making your products or services. Direct material costs plus direct labor costs plus indirect costs plus fixed costs plus variable costs gives you your total cost. As your business grows, you can switch to a more detailed formula that breaks down the different cost components. This helps you get a clearer picture of your expenses and makes managing your finances easier so you can make better decisions as your business expands. Calculating cost example for a loaf of bread. For direct material costs, you will have ingredients. Say it's $1.50. Plus direct labor costs could be wages, $1. Plus indirect costs, power, gas, phone, $1. Plus fixed costs, your rent, insurance, 80 cents. Plus variable costs, material labor, packaging, 50 cents. That brings your total costs to $4.80. Pricing. Pricing is all about figuring out how much to charge for your product or service. It's about finding that spot where you cover your costs, make a profit, and still keep your customers happy. Businesses look at things like how much it costs to make the product, what customers are willing to pay, what competitors are charging, and how much value customers see in it. In a nutshell, pricing is deciding what your customers will pay while making sure your business stays profitable. Pricing strategies. There are many pricing strategies businesses can use to hit their goals, whether that's boosting profits, grabbing more market share, or staying competitive. The cool part? You can tailor each strategy to fit your business style and what you're aiming for. Want to draw in new customers or grow your market? Penetration pricing or bundle pricing could work. Looking to keep up a premium vibe? Premium or value-based pricing might be the way to go. Every strategy has its ups and downs, so the best fit really depends on your goals, your market, and your customers. Cost plus pricing strategy. This is the best strategy for small businesses looking for a simple, stable pricing model. You figure out how much it costs to make your product, then add a markup percentage for profit. So, if it costs you a total of $4.80 to produce a loaf of bread, and you add a 25% markup, your selling price for a loaf of bread is $6. It's a straightforward way to make sure you're covering your costs and still making some money. Competitive pricing strategy. You set your price by looking at what your competitors are charging. This strategy works well in markets where there are lots of similar products, helping you to stay competitive. The loaf of bread example shows how businesses with the same product can charge different prices. The key is to stay competitive, maintain your product's value, and keep your customers in mind. Don't price too low and take a loss. But don't go so high that your customers choose your competitors instead. Penetration pricing strategy. You kick things off with a low price to draw in customers and build your market share. Then slowly raise the price once you've got a solid customer base. It's a great way to get noticed. This approach works great for new businesses breaking into an established market. Just be careful. Starting with lower profits might make it harder to raise prices later without losing customers. Skimming pricing strategy. You start by launching a product at a high price to get the most profit from early adopters. Then lower the price as demand starts to drop. It's a smart way to capitalize on excitement at the beginning. This works best for new, innovative, or tech-driven products with little competition. The downside? Budget-conscious customers might hesitate, and competitors could undercut your prices. Value-based pricing strategy. You base your prices on how much value customers think your product offers. If they see a lot of value, they'll be willing to pay more, even if your costs are low. It's all about what the product is worth to them. This approach is mainly used by businesses that really understand their customers' needs and what they're willing to pay. For example, people travel from all over Australia to Brookies Bakehouse in Brisbane, happily standing in long daily queues just to buy the famous Brookie cookies, rather than settling for a supermarket cookie from just down the street. Psychological pricing strategy. This strategy involves using pricing tricks to influence how customers see the price, like putting a price tag of $9.99 instead of $10 to make it feel cheaper. It's a sneaky way to help customers feel like they're scoring a better deal. Customer perception is the key here. Premium pricing strategy. You set a higher price to make your product feel premium and top quality. This strategy works well for luxury or high-end brands like Gucci and Tavs. While it can boost profit margins and build a strong brand image, it also limits your target market to those who are willing and able to pay the price. Bundle pricing strategy. You bundle several products together and sell them at a lower price than if they were bought individually. This encourages customers to buy more, so it's a win-win. However, while this strategy can boost sales and clear stock quickly, it needs careful management. If not, it could end up cutting into your profits. When it comes to costing and pricing, picking the right strategy is all about balancing profits and keeping your customers happy. Whether you go with something straightforward like cost plus pricing, or something a bit more flexible like value-based pricing, the main goal is to make sure your pricing matches your business goals and the market. Just take the time to know your costs, your competition, and most importantly, your customers. Nail the right pricing, and you'll not only boost your profits, but also build a stronger brand and loyal customer base.